Welcome to our complete deep dive on overheads. I know this chapter can be a real headache, one of the trickiest in the entire costing paper. But don't you worry, we're going to break down the entire journey of an overhead cost, from a simple expense all the way to the final product, step by step. Let's jump right in. Right, let's start with the big one. This right here, this is a classic exam trap. So many students trip up on the difference between allocation and apportionment, and ICAI knows it. Getting this wrong can cost you a solid 5 marks right at the start of your answer. So today, we're going to make sure you nail this every single time. So, to really get this, let's think about a simple factory. It makes chairs and desks. Now, you've got costs like wood for the chair, metal for the desk. That's easy. But what about the factory rent? You know you have to pay it, it's a real cost of making things. But how much of that rent bill belongs to one single chair? You can't see it, you can't touch it. And that right there is the fundamental puzzle of overheads.
First things first. Before we can start moving these costs around, we need to be absolutely crystal clear on what an overhead actually is. Let's get our definition straight.
So the textbook definition says it's an expense you can't conveniently trace to a specific product. In simple terms, it's all the essential background costs. Think about it. The factory rent, the supervisor's salary, the electricity for the lights. You absolutely need them to make your products, but you can't say, oh, that light bulb cost exactly 2 rupees for this one chair. They're indirect, and that's the key. Now you've got to know this table because ICA can and will ask questions based on any of these classifications. We can slice and dice overheads in a few different ways. By their function, like production or admin costs, by their nature, fixed or variable, or by their element, indirect materials, indirect labor, and indirect expenses. Make sure you're comfortable with all 3. All right, here we are, back to that 5-mark question. This is the very first thing you do with overheads, and I'm telling you, this is where most of the marks are lost. Let's lock this concept down so it never trips you up again. Okay, look closely. Allocation is dead simple. If a cost belongs 100% to a single department, you just put it there. You allocate it. End of story. Like the salary of a manager who only, and I mean only, works in the chair department. But apportionment, that's for shared costs. The factory rent benefits everyone, right? The chair department, the desk department, everyone. So we have to share it or apportion it on some fair basis. If you mix these two up, your entire answer is wrong from the very first step. It's that critical. Okay, so we've dealt with the costs in the main production areas. But what about the other guys? The canteen, the HR department, the maintenance crew. They don't actually make the products, but the factory can't run without them. This is where our next step, reapportionment, comes in. Just think about it logically. Why does the factory have a canteen? To feed the production workers. Why does it have a stores department? To supply materials to the production lines. These service departments exist for one reason, to support production. So it only makes sense that their costs should eventually be paid for by production. The goal here is to literally empty the cost buckets of all the service departments and pour every last drop into the production department buckets. Now, this is where it gets a little bit tricky, and you know what that means, right? It's a favorite of ICAI. What happens when the service departments help each other out? For example, the maintenance guys fix the canteen's ovens. For that, we use the repeated distribution method. Pay close attention to this one. Okay, let's walk through this example nice and slow. We've got service department X and service department Y. First, we take X's total overhead, and we give 10% of it over to Y. Now, Y's total cost just went up, right? So next, we take Y's new total, and we give 5% of that back to X. See what's happening here? We're passing the costs back and forth. But each time we do it, the amount gets smaller and smaller, until it's practically 0. That's when we stop and send the final amounts to production. All right, we know we have to share the costs. But the million-dollar question is, how do we do it fairly? We can't just split it equally. That's where choosing the right basis of apportionment becomes so important. This table is your absolute best friend in the exam hall. Seriously, memorize it. It shows the most logical way to share common overheads. And it just makes sense, doesn't it? You'd share the rent based on how much floor space each department uses. You'd share the canteen costs based on the number of workers in each department. In the exam, they'll give you a bunch of data, and your job is to pick the most logical basis from this table. The golden rule is always this. The basis you choose should reflect the benefit that department received. And here's the exam tip, so listen up. ICAI wants to see your logic. Don't just pick a basis at random. In your answer, you should pick the one that makes the most sense and is the most fair or equitable way to share that specific cost.
Okay, take a deep breath. We've made it this far. We've collected all the different factory overheads. We've funneled them all into the right production departments. Those cost buckets are now full. Now for the final step, taking those costs out of the production department's bucket and attaching them to the individual products. This is called absorption.
So how do we get that final overhead amount into the cost of a single chair? Well, there's more than one way to do it. We've got a few tools in our toolbox here. There are 6 common methods, and they basically fall into 2 main camps, the percentage-based methods and the rate-based methods.
First up, the percentage methods. These are pretty straightforward to calculate, as you can see from the formulas, but you gotta be careful. They're only really accurate if your overheads are actually driven by materials or labor. If your factory is mostly automated, using these methods could give you a really misleading product cost. Next up, we have the rate-based methods. Now, these are usually much more accurate because they're based on activity, and I want you to pay special attention to the machine hour rate. Put a star next to this one, highlight it, whatever you need to do. If a department is machine-intensive, this is the best method to use, and ICAI loves to test this concept.
So picture this. You're sitting in that exam. You flip the page and see a question just like this. You've got some info for Job 101 and Job 102, but the 2 absolute key rates you need, the factory overhead rate and the admin overhead rate, are nowhere to be found. This is a classic ICAI move designed to make you freeze up, and honestly, it works on so many students. But it's really just a puzzle, and it's totally solvable.
And hey, that is my promise to you. By the time we're done here, you are going to have the exact tools you need to solve this problem, and any others like it, step by step. We are absolutely coming back to this exact puzzle at the end, and you'll see just how neatly all the pieces fit together.
All right, first things first. You can't even think about tackling the big, complex problems until your foundation is rock solid. And for this chapter, that foundation is all about understanding the different types of overhead rates. I promise, if you get this right, everything that follows gets a whole lot easier.
So, what do we got? Well, the normal rate is just what it sounds like, what actually happened. Simple, right? The catch is, you can only calculate it after everything's over. The real MVP, the one we use all the time for making decisions, is the predetermined rate. This is our best guess, right? We figure it out in advance using our budget. It's absolutely crucial for setting prices and giving quotes for jobs before you even start the work. Then we have blanket versus departmental rates, which is really just a question of scope.
And right here, this is a classic ICI trap. Look, a blanket rate is easy, just one single rate for the entire factory. It's like a one-size-fits-all t-shirt. But it only really fits if you're in a super simple setup. The second you have different products using different machines in different departments, that blanket rate is going to give you some seriously misleading costs. And that's why the departmental rate, even though it's more work, is almost always the way to go. In costing, accuracy always beats simplicity. Remember that.
All right, enough theory, let's get our hands dirty. The machine hour rate, or MHR, is without a doubt one of ICAI's favorite practical questions to ask. So we're going to solve 2 typical exam-style problems right here, right now.
So here's our first one, illustration 6. We've got a machine that costs a whopping 1 crore, a 10-year life, rent, lighting, a foreman's salary, a whole bunch of details. Our goal? To figure out the cost of running this single machine for just 1 hour. Go ahead and pause here if you want to read the whole question carefully. Okay, ready? Let's break this down.
First up, we calculate the standing charges. You can just think of these as the fixed costs per month. Depreciation is pretty straightforward. Cost minus scrap divided by its life in months. Now, pay close attention to the apportionments. This is an area where so many marks are lost. The rent is for 1/4 of the total area. Lighting is based on 2 out of 10 light points. The foreman's salary is for 1/6 of his time. You have to be super careful with these bases. Add them all up, and we get total monthly standing charges of 97,366 rupees.
Okay, now for the final rate. We take our total monthly standing charges and divide them by the monthly hours, which is 365, to get the fixed cost per hour. Then we just add on the variable costs. Repairs are given for the machine's entire life, so we divide that by the total life hours to get a rate per hour. And electricity is simple, 15 units per hour at 5 rupees a pop. You add all those up, and there it is. Your machine hour rate is 382.86 rupees.
Awesome. Let's tackle another one. Illustration 7.
Now this one adds two very common twists that ICAI just loves to test. First, we've got unproductive setup time, where the machine is just sitting idle. And second, the question specifically tells us to include the operator's wages in the MHR, which isn't always the case. Let's see how we handle this. All right, here's part one. We figure out the standing charges for one machine over a 4-week period. But look closely at the wages. The operators get paid for all 48 hours a week. But, and this is a huge but, the bonus is paid only on productive time. So that's 48 hours minus the 4 setup hours, which leaves 44 productive hours per week, or 176 hours over 4 weeks. The bonus is only calculated on those 176 hours. This is a critical exam point. If you get this wrong, you're just throwing away easy marks.
Now for the machine expenses. And here comes another trap. The question clearly states that power is not used during setup hours. So again, the power cost is calculated on the productive 176 hours, not the full 192 paid hours. So the key takeaway here is that both the bonus and the power cost are based on productive hours. We add everything up, we get a total cost of $17,513.54. And for the grand finale, we divide that by the effective machine hours, the 176, to get our MHR of 99.51.
So we just used a predetermined rate to calculate our MHR. But here's the thing about that. Our neat, tidy, budgeted world almost never perfectly matches up with the messy, real world. And that mismatch is what leads to something we call under- or overabsorption of overheads. Let's clear this up once and for all.
You know, it's actually really simple when you think back to our rate formula, budgeted overheads divided by budgeted base. A difference pops up if our actual costs, the numerator, were different from what we planned. Or it could happen because our actual activity, the denominator, was different. Or, what's most likely is that both of them changed. The rule of thumb is easy. If the overheads you charged to production are less than what you actually spent, you have underabsorbed. If you charged more than you spent, you've overabsorbed. Simple as that.
So, what on earth do we do with this difference? This flowchart right here. This is your golden key. You have to memorize this logic. So first question, is there a difference? Yes. Okay, next. Is the amount small? If it is, great. Just transfer it to the costing P&L and call it a day. But if the amount is large, you have to ask another question. Was it due to a bad estimate or some abnormal reason? If yes, again, it goes to the costing P&L. But, and this is the important one, if it's a large difference for normal reasons, then you have to use a supplementary rate to adjust your cost of sales, your finished goods, and your WIP.
Okay, so that flowchart is the theory. Now let's see how it works in the real world with illustration 8. This is exactly how you'll apply that logic in the exam.
Step one is always to find the difference. Our actual overheads came in at 4,463,380 rupees. But we only absorbed 3,066,380 based on the actual hours we worked. So that leaves a difference of 80,000 rupees. And since our actual spending was more than what we absorbed, it's an underabsorption.
Now, this is the single most important piece of information in the question. ICAI will always give you the reason for the difference, because your accounting treatment completely depends on it. In this case, half of that 80,000 is due to normal cost increases, but the other half is because of factory inefficiency, which we treat as an abnormal reason. That means we have to do two different things here.
And this just perfectly illustrates our flowchart in action. The 40,000 that came from inefficiency, that's the abnormal part. It goes straight to the costing P&L account. It's basically a loss. But the other 40,000, the part from normal cost increases, that has to be spread across all the units we produced. So we calculate a supplementary rate of 5 rupees per unit. Then we apply that rate to the units we sold, the units sitting in our finished goods stock, and the equivalent units in our WIP. This makes sure that both our inventory and our cost of sales are valued correctly.
So we've really dug into factory overheads. Now it's time to shift our focus away from the factory floor and up to the head office. Let's talk about administrative overheads. These guys have their own set of rules and treatment options that you've got to know.
You've basically got 3 choices. 1, you could try to apportion them, but honestly, finding a logical way to do that is really tough. 2, you could just charge the entire amount to the P&L, treating it as a cost of the period. But the third method is super common in exam questions. You treat admin as its own separate function and add its cost to the product, usually as a percentage of the factory cost. And here's the kicker, this third method is precisely what we need to solve that big problem I showed you at the very start.
Okay, this is the moment we've been building up to. We have all the tools we need, we've mastered rates, we've nailed the MHR, we've figured out under/over absorption, and we know how to handle admin overheads. It is time to go back to illustration 9 and finally solve that intimidating reverse calculation problem. Let's do this!
Now don't let the algebra on this slide freak you out. It's just a logical process. Step 1, define your variables. Let's call F our factory overhead rate and A our admin overhead rate. Step 2, build your equations. For any job, the total cost is basically prime cost plus factory overheads plus admin overheads. We can write that as prime cost plus wages times F, all multiplied by 1 plus A. We can figure out the total cost for the first two jobs from their selling price and profit margin. Once you have those two equations with two unknowns, it's just a bit of high school algebra. A little bit of multiplication and subtraction cancels out one of the variables, leaving you with a simple equation to solve for A. You find out A is 0.25. Pop that back into one of the original equations, and you easily find that F is 0.60.
And now for the final payoff. We get to use the rates we worked so hard for to find the selling price for job 103. Factory overhead is 60% of direct wages, so that's $12,000. That gives us a factory cost of $56,000. Then, admin overhead is 25% of that factory cost, which is $14,000. So our total cost comes to $70,000. But watch out for one last little twist. The profit is 12.5% on selling price. Now you should know, 12.5%, or 1/8, on sale is the same as 1/7 on cost. So, 1/7 of our 70,000 cost is a 10,000 rupee profit, giving us a final selling price of 80,000. And just like that, we've done it.
So picture this. You're in the exam hall. You've just battled through a massive overheads problem. You check your workings, your rate calculation looks flawless, but when you look at the final answer, it's wrong. You're off. Why? What on earth happened? Well, that's exactly the mystery we're going to solve today.
To figure this out, we're going to put on our factory manager hats. We're going to follow a single overhead cost, let's say factory rent, right from the moment it hits the books all the way to the final product cost sheet. This journey is going to shine a light on exactly where things go wrong and, more importantly, how you can get it right every single time.
Okay, let's get started. The first leg of our journey is all about distribution. Basically, we're taking a big pile of general factory costs and sorting them into the correct departmental buckets. And trust me, getting this foundation right is absolutely everything. This first step is called primary distribution. The idea is pretty simple. You take a cost, like rent, and you split it logically across all the departments, both production and service. But here's the bit that's so important, the basis of apportionment. You have to pick the most logical driver for each cost. Rent gets split by floor space, power by the horsepower of the machines. Makes sense, right? Now, here's the exam tip. Get this basis wrong, and your entire calculation just falls apart. This is where marks get lost right at the beginning.
Okay, so all our costs are now sitting in their department buckets. But, wait a minute, we've got a problem. The service departments, like maintenance or HR, they don't actually make any products. Their entire purpose is to support the production departments. So we can't just leave their costs sitting there. We've got to move them, redistribute them to the production departments they serve.
And to do that, we have two main methods in our toolkit. First, on the left, you've got the repeated distribution method. You use this one when service departments help each other out, like IT supporting HR and HR supporting IT. You literally bounce the costs back and forth between them until the numbers are basically zero. Then, on the right, you have the stepladder method. This one is an exam favorite. It's a one-way street. You distribute a department's cost, and that's it. It can't get any more costs allocated back to it. The sequence you choose is key.
And here's that stepladder method in action. Just watch the flow. We start with Department P, empty its bucket, and spread the costs out. Then we move to Q's total cost. See that? Nothing goes back to P. It's done. We just keep stepping down the ladder with R and S until, at the very end, all the service departments are at zero and the production departments, X, Y, and Z, have soaked up all those support costs.
Awesome. Now we're at stage 3. All the overheads are finally sitting in the production departments. So what's next? Well, we need to figure out a rate to actually charge these costs to the products that pass through these departments. You can think of it like setting a toll fee for any product that uses the department's machinery or labor.
And a really common way to do this is with a machine hour rate, or MHR. Now, any rate is just cost divided by some base, usually hours. But hold on, before you even touch the cost calculation, we need to talk about the hours, because that denominator, that is a classic exam trap. Let's nail down how to find the effective working hours first.
And here it is, a perfect example of an IKI twist. The problem tells you there are 8 machines, but then it casually mentions there are only 6 operators. See the catch? A machine can't run by itself. The real bottleneck here is the number of people. So we have to base our entire calculation on the 6 operators, not the 8 machines. From there, we deduct things like paid leave and normal expected idle time to arrive at our true effective hours, 7,200. Getting this detail right is so important.
Okay, so with our effective hours of 7,200 locked and loaded, we can finally calculate the rate. We just need to add up all the relevant overheads for that period. The supervisor's salary, power, repairs, depreciation, the whole lot. Take that total cost, divide it by our 7,200 effective hours, and there we have it, a rate of 149.93 rupees per machine hour.
But life's not always that simple, is it? What if a machine sometimes does simple tasks, but other times it's hooked up to an expensive piece of computer equipment? Well, it wouldn't really be fair to charge every job the same high rate, would it? So the smart thing to do is to create 2 separate rates, a lower rate for when the machine is running solo, and a higher, comprehensive rate for when it's running with the computer. This makes our costing so much more accurate.
And that brings us to the final stage of our journey, the grand finale, the final reckoning. This is where we finally get the answer to that question from the very beginning: why was your final answer wrong even though your rate was perfect? It all comes down to what happens at the end of the year.
And the concept we're talking about is under or over absorption. Look, the rate we calculated was based on a budget, right? It was an estimate. But in the real world, things are never so perfect. Your actual costs will be different, your actual hours will be different. And that gap, the difference between the overheads you charged to products using your rate and the overheads you actually paid for, that's your variance. If you charge too little, it's under absorption. If you charge too much, it's over absorption. Now listen up, because this is so important. You can't just calculate this variance and leave it there. You have to deal with it, and there's a strict 3-step process. Step 1, calculate the amount. Easy enough. Step 2, and this is the crucial step, you have to analyze why it happened. Was it for a normal, everyday reason, or was it something weird and abnormal? And finally, step 3, based on that reason, you apply the correct accounting treatment. Steps 2 and 3, that's where the real marks are won.
And this slide breaks down that vital difference. On the left, you have your abnormal reasons. These are unexpected things, like a major machine breakdown, a factory strike, or maybe some really bad planning. These are treated as a loss. You write them off directly to the costing P&L account. They are not a part of the product's cost. But on the right, you have normal reasons, things like a small expected increase in material costs due to inflation. This is a genuine cost of production. So we have to spread this variance across all the work we did using something called a supplementary rate. Okay, we're almost at the finish line, but there's one more big idea we need to tackle, and it's all about the rate itself. Is it better to have one single blanket rate for the entire factory, or should we have separate, more specific rates for each department? Let's see why this choice is so critical.
Let's look at this job. The company uses a simple blanket rate based on wages, which gives them an overhead cost of 825 rupees. But now, watch what happens when we use more accurate departmental rates. For the department that's machine-heavy, we use a machine-hour rate. For the one that's labor-heavy, a labor-hour rate. Suddenly, bam! The overheads for the same job jump to 1,590 rupees. The total cost is way, way higher.
And here's the punchline. This isn't just about numbers on a page. This directly impacts the selling price. With that simple blanket rate, they'd probably quote a price around 4,600 rupees. But the true cost, using the much better departmental rates, means they should be quoting over 5,600. The terrifying thing is, they've been dangerously undercosting this job. They could be winning contracts and actually losing money on every single one they make. This kind of analysis is a huge ICA exam point.
Okay, time to bring absolutely everything we've talked about together for one final reality check, where we compare what we plan to do with what actually happened.
You know, a really great comprehensive exam problem will get you to do everything we've covered. It'll ask you to calculate predetermined rates from a budget, then use those rates to absorb overheads based on actual activity, and finally, prepare a full performance report comparing your budget to the actual results. It's the perfect way to test this entire journey.
All right, let's do a quick fire test. Ready? First question, what's the budgeted MHR? We take our budgeted overheads, divide by budgeted hours. That gives us 840 rupees per hour. Good. Next, how much overhead was absorbed? We take our rate of 840 and multiply it by the actual hours, giving us 25,20,000. Question 3, under or overabsorbed? We compare what we absorbed to our actual costs, and we've overabsorbed by 1,18,000. And last one, what's the supplementary rate? We take the normal part of that variance and spread it over the units produced, giving us 0.472 rupees per unit. How'd you do?
So at the end of our whole journey, what's the big lesson here? It's this: calculating an overhead rate, that's just the start. That's the easy part. The real test, the place where you really earn your marks in the exam, is in everything that comes after. It's about analyzing that variance, understanding the difference between normal and abnormal, and applying the exact right accounting treatment. That's the final twist in the story, and that's the one you need to be ready for.